We're going live. We're going live. I need to ensure that everything is working unless some of you guys tell me. Please. Okay. Okay. Let's see. Let's see. Let's see. Let's see. Yeah, typically there's some type of delay. Good morning. Good morning. Luncheon. I just want to make sure that it's all heard and visible. Beautiful. Miss Adike, good morning. Perfect. Okay. So don't need to check. Okay. So I actually just want to see how many people watching. So question is about the ecosystem, and we're going to be covering. We had some interesting calls this week. We're going to be covering the bridge today, potentially more. Wanchin is asking, may I ask about the time for the mainnet? Oh, that's a traditional question. Long time no see, as Wanchin said. Wanchin, can I ask you a question? How many nodes are you running today? Umar, good morning. Good morning. Okay. So we have three basic elements. Let me just check the thing first. We have three basic elements. We have Ghost Chain, we have Ghost Bridge, and we have Ghost DAO. And last time we touched upon Ghost DAO. I'm not sure if you guys had a chance to read the light paper once again to be more educated on the matter, specifically regarding the game theory component of 4,4, 3,3, how is that different, how the bridge is significantly impacting, improving the overall game theory component. So, but if we are to essentially have like this is the ghost chain, right? So this is the ghost chain, and then on the EVM here we have a ghost DAO, and then they're connected via the ghost bridge, right? So the ghost chain we've been covering for quite some time. Oh, my face is covering the ghost DAO. Okay, let's make ghost DAO on this side. This is a ghost DAO. Oh, okay, that doesn't work. Okay, like this, yeah. So this is ghost DAO, and then they're connected via the ghost bridge. So we spent a lot of time talking about Ghost Chain, and we still need to spend a lot of time. Good morning, Lorenzo. Ghost DAO, that's on the EVM, so that's fine. We should also proceed with this. That's fine. Now the question is about the bridge. And I don't think we covered the bridge that much. Although the bridge is, I wouldn't say the secret sauce is the bridge. Everything is a secret sauce. Ghost DAO is a secret sauce depending on how we're going to launch it and which chains we're going to launch it and the arbitrage opportunities. Ghost Chain itself is fast finalization, very low requirements, very permissionless. So everything is secret sauce. Bridge is perhaps the utility combining everything together, right? So like what comes first, the bridge, right? So point zero is a bridge, and then ghost chain and ghost DAO are the tools to make sure the bridge exists. And we didn't cover the bridge that much, and maybe we should. So let's do that, right? So we had this conversation with the council members. Good morning, Federal. And it's important to see the evolution because here's the thing: like most of you did not see the bridge ever, while we did have a bridge. So let me start sharing. So the first version of the bridge came out around November 2021, and we did have a demo back then. So around November, December 2021, there was a demo about how the bridge works. We had user interfaces, we had everything, like everything was there. And we showed it to the community members, and we probably even shot a video about it. I'm not sure if we did. Not going to be able to locate it potentially, or maybe I will. I don't know. But we then launched the first version of the Ghost Chain back then. around November, December 2021, we just didn't get that much adoption from the community. So we're like, oh, maybe let's focus on Ghost DAO, and then we launch Ghost DAO 3 months later. So that's the train of thought. And then after this, we're like, oh, now we need to still work on the community. So we launched the Telegram bot, and then we launched the Ghost NFT, and then we started working on Ghost Auction, Ghost Market, and Ghost Auction, and then we launched those on testnets, and we're like, you know what, let's just go back to the chain. So that's pretty much like the roadmap. So while we don't have that many mainnet products outside of Ghost Chain, so Ghost NFT, Ghost Airdrop, and Ghost Auction on just one mainnet, the amount of progress, like we've been always moving forward, always, and not just like research, but also like actual deployment. But let's go through the bridge design, what happened over the years. Like this is a great table that we created to describe all the changes, right? And maybe like the easier way to look at this is like this first kind of like first column like that, right? So the first bridge, November 2021. So what happened was at that point, we could still be bridging multi-assets. So for example, at that point, the idea was if you are bridging DAI, the DAI will be stored on the smart contract. And maybe I can even like actually, maybe I can even go. Should I go? Maybe not. So actually, maybe I should go. Maybe I should go to the specific slide. Okay, here we go. Yeah. So that was the original bridge, where if we are to bridge, let's assume DAI, right? Well, Solana was on it, but like from Avalanche, then GDAI would be minted on a smart contract, right? So if you're bridging Tether, this is USDT, of course. If Tether is being bridged, then GUSDT is being minted, right? And so on and so forth. So that was like the first kind of design where we would mint identical tokens, G tokens. And the reason why that was the case is due to the fact that that Ghost DAI was a thing. So John Market, he wanted to do Ghost DAI specifically, the Ghost DAI version. And we're like, oh, cool. So we're not just going to have Ghost DAI, we're going to have Ghost Tether, and Ghost Circle, and Ghost, I don't know, Ethereum, right? Like Ethereum would also be breached as GETH, right? So with this document, right? So the multi-asset was a thing. Now, the consensus protocol for the bridge was DPoA, Delegated Proof of Authority. So what's a proof of authority? Proof of authority is essentially a closed circle of wallets, accounts who are controlling the bridge. But since it's delegated, now you can actually rotate it. So typically, most bridges do not have this rotatable. So most bridges just have proof of authority. They say, oh, we have this number of validators, this and that. But the actual governance of the bridge is managed by proof of authority. So it's like 10 accounts or 8 accounts of each, well, specifically with the case of Axelar, 4 accounts out of 8 have to sign a transaction in order to make sure the transaction goes through. And then you have some validators, like 70 validators or so. And the question is, why are they there? And they're not really, they're not really serving the purpose of, like finalization of the bridge transactions. They are probably just there as light nodes, just like portraying stuff to the ledger. But it's 4 out of 8 accounts on the multisig into the proof of authority who control the flow of the bridge. Okay, that's cool. Now, regarding the validators for the bridge, for the entry, so we have entry and exit, right? So for the entry, in the first design, the blind counsel would have to be the validator. And the point with the blind counsel is that the requirements would be extremely high. So it would be 250,000 GMV tokens, therefore, and 10,000 DAI. Why 10,000 DAI? Well, it's not limited to 10,000, could be more, but essentially, council members receiving this huge allocation of GMV, they would be supposed to also offer additional liquidity of DAI, for example, on the side of the smart contract. So think about this. You have to have 250,000 Ghost bonded within Ghost chain, plus you have to have, let's assume, 10,000 DAI on the side of EVM to make sure that if you are misbehaving, if you're malicious as a blind counsel verifier, validator, whatever, on the bridge, the 10,000 DAI will get slashed. right? So the requirements were just pretty high. Now, is it good or bad? This design is still better than any other bridge out there right now, despite super permissioned, right? Like this is, I would say, permissioned. Like it's a pretty heavy allocation. Despite pretty permissioned minimum requirement, this bridge is still more decentralized than other bridges out there because we would have the functionality of smart contract rotation. So a new blind council, as long as they get 250,000 ghosts, they would be able to become a blind council, and therefore they'll be able to also validate these transactions. Now, the other problem is the transactional cost. So depending on the number of validators, let's assume it's n blind councils. So therefore, the transaction on the entry would be proportional to how many validators we have, how many blind councils we have. So if you have 10 blind councils, the transaction is going to be 10x, right? If we have 100 blind councils, it would have been 100x, right? So that's the situation. On the exit, we would have the same thing with the first design. So it's the same requirement and same situation. Problem is, on the entry, it's O to the N in ghosts, right? So in ghost, meaning in ghost specific transactions. So ghost transactions are pretty cheap, so you can see it. So therefore, in ghost specific transactions, maybe that's not a problem. But in Ethereum specific transactions, ON, that becomes a problem. So for example, if you have, again, 100 validators, 100 blind councils, on the exit, you would have to pay a transactional fee in ETH proportional to 100 blind councils. So as the system is scaling, so as the system is getting more blind councils, the transactional fee of the exit is becoming more expensive. And we would explain this as, listen, if you want a more decentralized bridge, you need to pay more. So that kind of makes sense anyways, but that was the design, right? That was the first design that we had in 2021, November. And this design is still more decentralized than anything else out there. That's the surprising part. But we kept moving forward. We're like, okay, cool. How about the next design, Ghost 2.0? And Ghost 2.0 made this design better. How? So the exit wouldn't change much. The exit stays the same. Doesn't really change much, right? What does change though is the entry. So on the entry, you would still do multi-asset. So you would still do, GDAI type of scenario or GUSDT type of scenario. But now on the entry, you would have what? You would have validators as all validators. So all validators would now be able to validate entry bridge transactions. How? Because every single node would now be not just maintaining the ledger of the Ghost chain, but every single node would also be listening to the gatekeeper smart contract on every EVM as a listener and relay data as an off-chain worker. And once the data is relayed as an off-chain worker, there is a massive consensus, boom, the transaction is registered. The transaction registering on the entry means what? If somebody moved 100 DAI from Ethereum to Ghost chain, those 100 DAI will be locked in a smart contract, and then 100 G DAI will be minted. Based on the consensus that 100 G DAI is minted, that's it. And the reason why that's okay is because on the entry, you don't have that many risks. Because on the entry, all you do, you are moving liquidity into the smart contract. You're not moving it out, right? Like when we say, oh, bridge is getting hacked, bridges are getting hacked on the exit. They rarely get hacked on the entry, never, right? Because like you actually put liquidity on the entry, you put that liquidity into a smart contract. And then we just need to properly mint the proportional amount of DAI to a G DAI compared to how much DAI you locked into a smart contract. So now the revolution with the bridge entry, due to this technology we call it slow clap. So the validators would now be validating all the entry transactions. And the requirement for being a validator drops significantly. No longer is the blind council. Blind council is gone from the entry. They only exist on the exit. But the minimum requirement to become a validator, let's assume it's one ghost. Of course, today it's one ghost, like we're thinking. With the testnet, it's 6.9 Casper. Once we're going to launch, it's probably going to start with one ghost, and we're going to slowly, gradually increase it to like 10 ghosts, etc., whatever. So minimum validator bond is one ghost. And the transactional fee for the validators is free because they are themselves validating those entry transactions. So the Ghost 2.0, this revolutionary thing in September 2023, was the fact that due to slow clap nature, we can significantly ease the entry to the bridge in a decentralized way and make it significantly more decentralized. No longer is it just the blind council. It's now every single validator is the validator. Every single ghost validator is also a bridge validator. And the requirements to become a validator are extremely tiny. Okay? If you guys have any questions, please ask. But we still have multi-asset. So then we moved to, let me just remove this. Then we moved to the next version, 2.1. 2.1 was this accidental version, completely accidental. We're like, oh, we didn't think it was a big deal, but it was a big deal. Because what happened with Ghost 2.1 is we significantly minimized the requirements to become a validator on the exit. So you see how here it was 250,000 ghosts and 10,000 DAI. Now it's the same as a validator requirements. Why? We said we're not going to do multi-asset by multi-asset. So no longer are we going to have, like, if somebody's bridging DAI, it's going to be GDAI. No longer do we do that. If somebody's bridging DAI, DAI will be converted to Ghost via Dexes and Ghost DAO. And now you're only bridging Ghost. So you're never bridging any other asset but Ghost. Ghost is the only asset that you're bridging. So you see it says multi-asset via Ghost. So any asset that you can be bridging is through Ghost. Federal is asking, I'm curious about the bridging time. How long does it take to bridge? So the bridging time typically for the existing bridges takes my practical experience takes about 20 minutes. And I'm talking about Arbitrum Bridge, I'm talking about Optimism Bridge, I'm talking about Linear Bridge. Not only that, not only this time is 20 minutes, but you have no idea what's happening. So when you bridge, they just tell you, oh, we'll get back to you, and you just wait. And you just hope for the best, like literally. Like you have no idea what's happening. So what we would like to change is we would like to introduce some type of Amazon-like structure, like shipping time structure. So like traditional bridge, right? You bridge DAI, well, you bridge ETH. You cannot bridge DAI really. So, and when you bridge it, like this is Ethereum chain, and this is Arbitrum chain. They just say transaction registered is in progress. And you just wait. Like you have no idea what's happening. Like you have no clue, no visibility, no transparency. And it's pretty scary. The reason why it's pretty scary because first of all, some of our council members even got hacked on the bridges for pretty decent amount of money. So that's a real pickle, and you don't know what's happening. Like maybe it's gonna take an hour. Sometimes one time I think it took like a day, 24 hours for me to bridge like small amounts of this thing. So that's what's happening. For us, therefore, we would like to introduce this scenario where it's like this is Ethereum, right? So, okay, so you moved your DAI, for example, into a smart contract. You will see, okay, now DAI got transferred to eGhost. Oh, now eGhost got wrapped into Ghost, all on the back end, right? Oh, now Ghost got Ghost token. Oh, now Ghost token got breached to Ghost coin. Oh, now Ghost coin is being breached to Ghost token on the, on the Arbitrum chain, right? Arbitrum L2. Then, oh, now Ghost token is being breached, being unwrapped into eGhost. Oh, now eGhost is being, swapped for Tether, whatever, right, on the DEX. So that's how this works. So the overall process should be taken, should depend on the transactional fee on the network. So let's assume this is like 10 blocks of Ethereum or 5 blocks of Ethereum until finalization. This will be, I don't know, maybe like a minute, 1 minute. This is going to be like a minute, so 10 blocks. So this will be super fast, as you know, will take like 6 seconds. Well, let's assume 18 seconds with 2-3 block finalization. This will probably be the same, and then this will take like also like a Ghost token to eGhost 1 minute, and this will also take 1 minute. So overall, if you count it, it's probably going to take around 5 minutes with an insane amount of transparency at every single point of the way, at every single step in the way here, right? So probably that's probably what we're looking at. And we will see this on the testnets, right? Like once we launch this, so we're launching Ghost DAO in 2-3 weeks. Well, actually, in a week now, I think, a week and a half. So once we launch that Ghost DAO first version, we'll then relaunch the second version, and then we'll slowly, maybe around the summer, you'll have the bridges. and you will see for yourself how much. But it's not going to take 20 minutes for sure, and it's not going to be invisible. You'll know exactly where you are. So that's kind of the idea. But that's a good question. So let's go here back, right? So go October 2020, so Ghost 2.1. So now every single asset is being breached, denominated in Ghost. Like whatever you breach, you denominate it into the Ghost token first, and then you breach Ghost token only. And the reason why that's cool is because now the breach consensus is, well, from 2.0, it was already NPOS, nominated proof of stake, where every single validator now can really become a validator of the entry breach. And on the exit, you just need Ghost balance, right? Because if you're acting as malicious actor, you don't need to have 10,000 DAI anymore. You just need to have, let's assume, 250,000 Ghost. Worst case scenario. Ideally, you need like some kind of tiered approach. Like for example, tiered Ghost. If you are bridging, if you are the validator who is participating in bridging $10,000 worth of transaction, then you have to have $10,000 worth of Ghost bonded. But most transactions are small transactions, like say 10 Ghosts or 100 Ghosts. Okay, then in that case, you need to have $100 worth of Ghost on the Ghost chain. So no longer do you need to have additional DAI. You just lock everything in Ghost token inside of Ghost chain. Right? So the validated requirements are tinier. The only problem with this with this bridge was the transactional fees on Ethereum were still scalable, proportional to how many validators you have. So the more validators you have, the more expensive is the transaction. And that was the biggest turnoff. So like the entry is free. The entry is good. The exit is proportional to how many validators. And again, how we explain it, just to reiterate, listen, you want a more decentralized bridge, you have to pay up more. It sounds cool. Maybe it doesn't sound cool to the user, but it really sounds cool as from perspective of of incentives and etc. You pay what you get for. You get what you pay for. That's like totally proper. Okay, and final design that just came out like last month, not even 2 months, like last month, is this one, where what happened was due to the updated novel advancements in cryptography, we were able to significantly minimize the cost of exit. Also, not proportional to how many validators, but just one transaction on Ethereum, that's how much you pay to exit. And if you guys know the transaction, so I'm not sure if that was a good move by Ethereum, but that was a move. So Ethereum decided to what's the word? Basically minimize transactions. So those of you who minted NFT before on JML on Ethereum, you used to be paying like maybe up to $20 per transaction. It was pretty expensive. Maybe $10, maybe $5. When I minted Ethereum recently, like a JML on Ethereum recently, I think I paid like 8 cents. They dropped it significantly. The gas fee is lower. I don't think that's a good necessarily idea for the validators, for the stakers. I don't think so. But the fees are significantly lower on Ethereum. And the problem we have is mostly with Ethereum because all the other blockchains are cheaper. Not as advanced, whatever, but they're actually cheaper. Like you look at BSC, Binance Smart Chain, Avalanche, etc. Like these are peanuts. So the only thing we really need to consider was Ethereum because we do expect Ethereum to be, one of the bigger players of the bridge. Ethereum chain, because that's where all the TVL is. 68% of TVL is between Ethereum and Tron. 68%. That's it. These are the two top blockchains in the world. And no matter what people say about Solana and Avalanche and Polygon and blah, 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 it's Ethereum and Tron. That's it. Therefore, we needed to minimize the transactional fee on Ethereum, and Ethereum itself also decided to drop the fees. I'm not sure why again. So therefore, the transactional fee on the exit is becoming now absolutely reasonable. So the entry is free to the validator. The user will still be charged something. But the cost, the expense itself to process a super decentralized, no matter how many validators you have. You have 1,000 validators, it's one transaction. You have 10,000 validators, it's one transaction. The fee. The cost of the exit bridge. So that advancement is absolutely fueling us to move super fast with deployments. Going back to one chain, most popular question, when is mainnet? So essentially, thanks to that super recent cryptographic research. Like it's pretty much like as if it was published yesterday. Like it's so fresh. We're able to move forward. Not only that, but we are potentially able to also add the Bitcoin bridge to it. So not just bridge EVM blockchains together, but also UTXO blockchains together, including Bitcoin, Litecoin, Bitcoin Cash, Monero, Zcash, Dash, and a bunch of others. Right? Maybe even actually XRP potentially. So potentially. So yeah, so that's kind of how this works. Any questions here before we move forward? Please, actually, maybe just ask your questions, and I'll just like be switching back and forth. Okay, so that's cool. Okay, so what? So now what? We have this amazing thing. The bridge is working. How does it do anything? So let's go now to Excel and let's see. So the bridging volume itself. So people talk about AI, how AI is so cool and AI will change the world and blah blah blah. And of course it won't. I mean, just because you can write things better, that's great. But you're subject to all types of faulty information. AI is as good as the information, right? So garbage in, garbage out. There's lots of information regarding how to write stuff, but you should try it. For example, in English, the models are pretty well trained, but try to use these models in other languages that don't have that much information online, and you will see the difference. If you speak Spanish or, yeah, even Mandarin, like, actually, maybe the best example is Japanese because you don't have it's a big country, but nobody really speaks Japanese outside of Japan, for the most part. So see how well your model is going to be trained. You will see that it doesn't rewrite stuff much. So it's all cool, but it doesn't really, you know. In any case, we need to look at the hidden trends, and the hidden trends exist when you can spot the actual numbers, right? When you can quantify it. So this is the bridging officially from DeFi Llama, these numbers, and they go from October 2022 to March 2025. And this is the chart. And with your permission, I did not look at this data yet. So I did not include March 2025 because we just half of March. So obviously there's a downtick. But if you look at the end of February, for example, here. So with your permission, let's just stop messing with the data. Like I didn't mess with it myself yet. So let's calculate the changes first. So the changes are going to be right. I'm just messing with it right now. So this over this -1. So yeah. So this has been the month-over-month changes. So some super high, like 300% upside, etc. So the average change has been about 24% per month. That's not the right way of measuring it. So let's do the average. Average is the average is 24% a month. So that's the rate of increase monthly. Now, if you look at the top accelerators such as Y Combinator, startup accelerators in the world, they say that if your startup can grow by 10% a month, you will fucking move mountains. Like this is like amazing. Now this market, not the startup, the market is growing by 24% a month. The market. Like if you launch a startup that makes a product around this bridging, you should be moving with the market at 24% a month. And I don't see it stopping anywhere, right? Like there was definitely some shallow kind of, trend behavior here between March 24 and October 24, and then it picked up again. So, but that's not, I think, the accurate way of looking at it. So maybe a more accurate way to look at the cumulative change will be if we do something different, we go ahead and divide February 2025 by October 2022, and let's raise this to a power. I'm not sure what power is this. How many months do we have in between? So we have 29 months in between. So let's raise this to the power of 1 over 29 minus 1. So we see 12 and a half. So call it 13%. So that's potentially a more reasonable estimate. Like 24% was more linear estimate. 13% is more cumulative. So again, going back to Y Combinator, I didn't know these numbers. I'm just like finding them out with you. So 13% per month that is the increase of the industry every single month. That's how this works. On the bridging side. Now, what's interesting to see is this is just bridging, right? So these are decentralized bridges. The people are taking their massive risks, bridging wormhole, bridging through, I don't know, through Rainbow Bridge, bridging through freaking Circle CCTP bridge, and so on and so forth. So like you bridging through that. Okay, cool. How does it impact me? So we had this model. I showed this to somebody earlier this week where we forecasted like the valuation of like if you said a ghost is a is a project, a ghost is a business, right? Like how would we price it, right? So the bridging fees here. So let's go through stuff, right? So that was back from 2022, 2023 type of model. Nothing has changed except for the coefficients. So nodes, transactions, and liquidity. So back then the node was $150,000, transaction was $287, $88, and liquidity has been 31. So what happens is every single node, just like we did before, every single node is responsible for $150,000 of market capitalization. So you add one node, you just added 150 grand to market cap. Transactional fee. So every single new daily transaction, that's $288 to market cap. And liquidity, every single dollar of trading liquidity on SEX or DEX gets you to $31 of market cap. And then you would also have bridging fees. And then you would look at how can we grow, right? Like, and this is, as you see, month 0, month 1, month 2, and this is month 60. So typically this is like 5 years in, 5 years out. That's how you do the projection. And again, this is a disclaimer and not a financial whatever. This is just for entertainment purposes, blah, blah, blah. So the reason why bridging fees are growing by 16% per month is due to the fact that the stable coins were growing by 16%. So specifically, what about stable coins? Stablecoin volume, including Tether, Circle, DAI, BUSD back then, was growing by 16% every month. So what we did with the simulation, we said, okay, fine, 16% is too heavy. So how about we grow until month 30, I think. Yeah, month 30, by even more, month 36 maybe. Month 36, we grow by 16% every month. And then after this, we drop 5%. We only grow by 11%. Mind you, this stats was conducted 2022. So 3 years later, first of all, it's not 11%, it's 13% at least on the bridging. But if you look at the stablecoin volume, I need to do this analysis, but it's probably going to be relatively high. It's probably going to be the same 16%. Whatever, we dropped it by 11%. So we're just trying to estimate the market. Same thing. If you say, okay, cool, we start with growing nodes, daily transactions, trade liquidity. This stuff grows by 10% every month, right? And then as well, 3 years later, at month 37, therefore, like it was 10%, now it drops to 5% every month, right? So because the project is becoming more mature. So that has been the simulation, right? So the first 3 years, it grows by 10% and 16% respectively. And then 3 years later, it grows by 5% and 11% respectively. And we said, okay, cool, what's the starting point? So how much can we start with? So nodes, start with 100 nodes. Back then, it sounded crazy because I already knew the statistics. I already saw that 100 nodes is pretty a lot. Today, it doesn't sound that crazy because even today we have 82 nodes. By the way, in case you don't know, we may have a lot more nodes. Just lots of nodes are not. So there may like I think I outlined 3 ways why nodes are not like lower than from other versions. Like some people still on the old version, etc. But some people can run nodes and not add telemetry, so you won't see them on telemetry yet. They still run nodes and still validators, right? So that's absolutely possible. So you may have more than 82 nodes or whatever you have. So 100 nodes, absolutely not unrealistic, totally realistic. Daily transactions. So I would like to see how many transactions we have today on the testnet, because every single time you send a transaction, like you send Casper, that's a transaction. Every single time you claim your staking reward, that's a transaction. Every single time you're trying to maneuver between your stash and staking wallet, that's a transaction. So like you have so many freaking transactions. Every single time you're on stake, every single time you chill, every single time you are making these transactions. We didn't even get to the governance yet. Every single time your node is, every single time your node is winning some staking, like that's also a transaction. Like there's so many transactions even now with just 30 validators and 82 nodes total. It's crazy. So I would like to see how many we have. So we said, okay, 10,000, that's the starting point. And trade liquidity, we said $1 million. So why $1 million? So trade liquidity is more like it's a little bit of a pickle, like how to really measure it, and that's the biggest like component. Like we can measure, um, we can more or less estimate, some type of conversion, like how many nodes we have on the testnet, and then we say, okay, cool. Like on the mainnet, we'll have a little bit more, a little bit less. But how do we really measure TVL? Like if you have TVL and goes down, how does this translate to the TVL on the mainnet? We don't know. Like right, we actually have no idea. So we need to like figure this out. Once we're going to be launching Ghost DAOs and with your help, guys, as well. But 1 million, the reason why is because the council said that total they can commit to 1 million TVL roughly throughout, like amongst all of them. So roughly that. And then it grows by 10% a month, and then daily transactions grow by 10% a month, and then nodes grow by 10% a month. And an interesting point, yes, that's pretty aggressive, and that's a model. So we're not trying to say that that's what's going to happen. That's a model. So we can change this to 5% and see what's going to happen. We can change this to 8% and see what's going to happen. Like the point is to have, have some type of valuation tools to help us evaluate where we will be. So the market capitalization with these three parameters, and with the parameter of like with these three coefficients, which have been significantly outdated. So this number, for example, is no longer 150 grand. It went up to $400,000. In 2022, Bitcoin was $16,000, I think. Today it is $80,000. So you multiply this by 5 at least, right? Like all the other coins went up significantly as well. So you at least multiply this by 5 because I don't think the fundamentals changed much. But our number is roughly 10 million per node. So we're not even going there. Like let's assume it's just 150 for now, which is still pretty high, but that's what it is. In which case, the market cap the first month is going to be at $50 million, right? And given our supply, roughly 30, we don't have 30, it's actually less. We have probably, I would say we have like 18 million, but let's keep it at 30, right? Whatever, 30 mil. So the price is going to be 1.65. And that's how you know what the price will be. This is for entertainment purposes only. This is by no means what's going to happen. This is just us making fun estimates of, oh, we have some coefficients based on comparable statistics. And then we just putting all these coefficients together. So each JV you have is 165. Now, some of you guys minting JV mindlessly, and of course we will be taking charges and taking precautions against that, right? Like if you have lots of JV and you don't have users, like you kind of brought some people, but it's like some fake users or some bots, whatever. You kind of minted JV, but it's not real JV. We'll have precautions against it. Trust me. Like it's not gonna you're not gonna bridge it. Conversely, and the community will be deciding that, right? Conversely, the community is not going to be happy about it. Trust me. Like if you just have some fake supply of JMV. Conversely, if you do actually if you actually did earn JMV, like brought users, brought nodes, of course that is very, very different. So, but just look at these numbers and what's going to happen. Like if you're going to proceed with this notion, by the way, the supply also grows by 10% given the inflation, right? So the supply also grows. So it was 30 million, then it's like growing. The reason why it's not 10% because this is monthly, right? So if it grows by 10% a year, 10% a year is inflation, right? So 10% a year divided by 12, that's going to be roughly whatever, 0.83 or whatever. So that's what it is, right? So if you're going to continue this simulation, the price of 1.65 per token shall grow to roughly $115 in 5 years, right? And the market cap should be at 5 billion, and the supply should be at 42 million, right? So again, these are fun stats. Like this is not what's going to happen. This is for entertainment purposes only. But this is quite interesting to have this model and just to estimate like where we are, what we're going to have. So 50 mil, we're going to get there. I think 100 nodes is pretty realistic. Let's assume daily transactions is not 10,000. Let's assume daily transactions is 100. And trade liquidity initially, not a million. Let's assume it's 100,000 because I think that's very achievable. See, now market cap dropped significantly. So now it's 18 million and the price is 60 cents, right? And then boom, it grows here to $42 and 1.7 billion, right? So that's what you have. So one GMV is 42 bucks, right? So you play with this, with this stuff, and you now know what you need to do. So you asking like, oh, why do we need to bring more validators? Or why do we need to make more daily transactions and like mess with the network? You know, like some feedback from yesterday from Wales, like, hey, you guys make mistakes. The more mistakes you make, the more transactions you generate. The more you learn, the more transactions you generate. The more transactions you generate, let's assume it's not 100, it's 10, it's 1,000. Boom. So now it's like daily transactions. By the way, you can see does not really impact it much. But now TVL bot goes down. Oh, like when we look at launch goes down, we want you guys to participate. We want to increase it. Like if the TVL is $50,000, that's one thing, right? If the TVL is $500,000, you can see how now all of a sudden it's like double the price, right? It was 57 cents, now it's $1. So these metrics are important, and when you are improving these metrics, you're not just helping yourself, you're helping the protocol, meaning you're helping yourself and everybody else. So that's how this protocol works. Like that's how this Web3 situation has to work. You are benefiting as a user. You are self-centric. You are selfish. You will just want to benefit yourself. But by benefiting yourself, you benefit in the network. That's the beautiful thing about blockchain. That's why I fell in love with this technology. Because I'm like, wow, this is so fucking cool. Like if you benefit yourself, you benefit everybody else as well. That's cool. Of course, when you benefit yourself, you're not necessarily like, you're not going to get 100% of the benefit that you bring into the network. You're not. But you benefit yourself. A MetaNomad benefits yourself. Federal benefit, like we all benefit ourselves, and then together we're building this network effect of value. That's what it is, right? That's how you should be thinking about it. Let me respond to some questions. MetaNomad, GMV, good morning. Good morning, goes. Does it impact our settings in terms of percent of commission? Yes. Well, that's a great question. I'm not going to discuss it right now, but that's a great question to discuss. Meaning, should we adjust our node commissions accordingly? Oh, I see. We didn't even get to this yet. So we didn't even get to this yet, what you are talking about. But I'll cover this in a second. Federal. I'm still confused about staking. Is it Ghost Coin we are staking or GMV token on each chain or both? So Federal, you are staking Ghost token on Ghost DAO, and you're also staking Ghost Coin inside of Ghost Chain. That's what it's going to be. GMV will be swapped for eGhost, and then eGhost can be then swapped for Ghost token, and then Ghost token can be bridged to Ghost Coin. So you're gonna get GMVs will be swapped for pGhosts, and yeah. So that's it. So you won't have any GMVs. So you're not gonna be staking GMVs. You're gonna be staking either Ghost tokens or you're gonna be staking Ghost coins. So far so good, right? On the market cap, on the price. Now an interesting thing is, what about bridging fees? Those are extra. Right, so we probably need to make a video. What makes Ghost so different from all the other blockchains? In other blockchains, the model is you are having increase in supply due to inflation. So let's assume the inflation is 50%, right? Boom. So the price is $1, right? At 50%, the price is $18 because it's so massive. Now, if inflation is 75%, now the price is $9, right? I can make the inflation 100% per year. Can I make it? Yeah. What's going to be the price? So the price was $1, and then here's $4. So it doesn't really grow that much, right? Because like all you do, you increase the supply by having higher inflation, but the fundamentals stay the same. So if you don't change the fundamentals, it's not good. But if you go back to supply of say 10%, you don't really dilute the supply that much, so it goes from $1 to $72, right? So most blockchains, what they do, they significantly increase the supply, inflation, and on the piece of paper you say, oh cool, like I have like whatever 100% APY, but price drops because the supply is increasing and the fundamentals don't increase that much, so the price is dropping, and therefore you just actually end up, in most cases, even losing. If you look at the performance of Bitcoin versus everybody else, I think Bitcoin is the only, maybe Solana this year, again, I keep saying this, maybe these two projects are up compared to the highs from 2021, 2022. Everything else is down, including Ethereum. Ethereum is significantly down. Bitcoin is up 3x. Sorry, actually no. Bitcoin's high was 60 grand and 65. Now it's 80, so it's up like, let's assume 20%. But what's it called? But Ethereum used to be 4,000, now it's 2,000, so it's down 50. And Ethereum is like the best thing after Bitcoin, right? So that's interesting. Olympus DAO, by the way, don't think it dropped that much. So we need to like look into that stuff. But yeah, that's what we're dealing with. So now, what's the word? Now the question is, how can you then integrate? Like, how is Ghost different? Well, Ghost is first of all keeping the supply inflation pretty limited, right? And we're trying to improve the fundamentals, so we need more nodes, more daily transactions, high trade liquidity. But also the bridging fees. The bridging fees are also increasing. And the bridging fees serve as an additional fixed income type of benefit to the protocol. So what we do with the bridging fees is we essentially disrupting the centralized exchanges. We taking bread from centralized exchanges and distributing them not amongst the shareholders of Binance or shareholders of KuCoin, but we are distributing these bridging rewards with you guys, with whales, with ghosties, with everybody who is a validator or a nominator, and also obviously council members. So those bridging fees, if you start at $10,000, for example, they increase by 16%. What's happening is by month 60, you're going to have $25 million per year of bridging fees. It's crazy. And when you sum them up together over the course of those 5 years, you look at 250 million bridging fees. Right? So again, this is just simulation, and this keeps increasing. It's just simulation. But what the simulation is supposed to show us is that we are we're not here just to mint. If you guys think you can just mint GAV and hack the protocol, no, it doesn't work like this. If you think that you can just run a node and that's about it, that's definitely better, but that's not enough. Because what you do when you run nodes, you're essentially helping yourself, not being 51% attacked by the rest of the network. So you need to run more nodes because you're self-incentivized, which is good, and you're also helping. But what needs to happen is there has to be TVL, there has to be daily transactions. People need to be bridging. Therefore, you need to bring more users to make sure these more users are actively bridging. So you need to educate your network about Ghost, about GhostDAO, about Web3 in general, what's what. And this has been the type of the simulation scenario for a council member, like how much the council has 250,000 Ghost tokens, and then multiply this by the price of $1, and then that's like the initial allocation, and then how much it grows, and then also staking rewards on top of that, and also bridging fees on top of that, and it's turns out to be some crazy freaking number, like crazy payout, like 1,000x their money. That's kind of has been the thing. I'm not gonna go into this today. Moreover, we need to kind of slightly change this model, but overall, the difference between Ghost and all the other protocols is we have a very, very intricate, sophisticated, interesting business model, so-called, for the protocol, where the protocol is not just generating fees from transactions, but we're also generating bridging fees. And some percentage of these bridging fees can go to back up GhostDAO, for example. Some of those bridging fees can go ahead and sponsor additional validators, as nominators. So for example, somebody has like 20 machines to run, they don't have enough Casper, they don't have enough Ghost. So the bridging fees could be utilized by the treasury to purchase back more Ghost and nominate other existing nominators, thus making the protocol more resilient, right? And yada yada yada. Like you can do so much with this additional traffic of bridging fees because the bridging fees belong to the community. That's kind of the massive difference. MetaNomad, could Ghost be categorized as crypto black pool? Thinking of the bridge plus anonymity. No comment on that. Wink, wink. You're asking very controversial questions. I'm not gonna respond. Not on camera. Mr. EduK, love to see the diagram of the entire process, including egos, P-goes, Ghost Chain, GhostDAO, I think visually. So that would be super helpful. Happy to help make that. Yes, absolutely. So I think we showed two of those flows on the Whales Wednesdays this Wednesday. Maybe we can revisit this again, or maybe I can just post this in the Whales, and you guys can go ahead and take it away with it. So overall, that's what we're dealing with, right? Like we are in a growing market. The market is growing itself by 13% as we established today. I don't think that's it. I don't think it's 13%. I think it's way more because we need to add the volume of stable coins and the volume of some other. Like for example, when I see the stable coin USDT to USDC on a SEX, chances are that's a bridging type of behavior. Because why would I go to a SEX to trade from one stable coin to another stable coin, right? Like I probably want to trade between different chains, right? So the stablecoin of Circle to Tether should be categorized as a bridging volume, right? So if you incorporate that bridging volume plus the bridging volume from the DeFi Llama, I mean, we can see, we will probably see way more than 13%. Again, I need to do all the stats. I need to present it to you guys whilst I'm doing it. But the market is growing. So people say, AI. Guys, the market of bridging, if you're just an average bridger, you shall grow with the market at 13% per fucking month. Per month, not per year, per month. Right? So if this is not exciting, I don't know what is. Like, what is expected? Bring more nodes, make more transactions, make mistakes. And once the ghost dies out, watch out. Offer as much liquidity as you can, in your self-interest, of course, to generate this trade liquidity so we can start updating this model together. All right, on this positive note, we'll end. Thank you so much.